absolutely a bubble.
The bubble.
It's 100% a bubble.
Apple, Microsoft, Tesla, Amazon, Alphabet, Nvidia, and Meta all lost billions in value. You have to realize that a bubble has in fact popped.
This is it.
If you're a tech investor, it's been an absolute bloodbath. Just look at this chart. On the left, you'll see in the dot-com bubble, Amazon fell from 55 times revenue to 1 times revenue. In present day, on the right, Shopify fell from 70 times revenue to 7 times. There's an eerie similarity here directly affecting tech, which we didn't see in the Great Recession of '08. But is this just a momentary correction, or the beginnings of a cataclysmic dot-com collapse? If you're working or investing in tech or a startup founder, we're gonna break down what all of this means in this video. It's sometimes easy to forget just how catastrophic the dot-com boom was. It was a time when investors and founders were captivated by the exciting unknown of the internet, fueling massive speculation. In 1999, there were 457 IPOs that returned a staggering 89% on average in their first day of trading. It's hard to believe, but many of these companies actually had 0 revenue, and others were burning hundreds of millions in marketing unprofitably. One company, Pixelion, threw a $16 million party before Y2K. And of course, that party had to end. By October 2002, the Nasdaq had lost 78% of its peak value, erasing 5 years of gains in the process. Even well-known companies like Amazon crashed from more than $100 a share to less than $7. Things were so bad that traffic literally vanished in Silicon Valley. So many people were leaving the tech sector that the terms B2B and B2C became back to business school and back to consulting. By comparison, as of this video, the Nasdaq has only fallen about 25% from its all-time high. So what we're seeing today is still just a fracture in the ground compared to the eruption of the dot-com era. But to understand if things today are going to get much worse like the dot-com era, we have to understand what's causing this current bubble. Since the Great Recession of '07, we've been in an unprecedented decade of quantitative easing, almost 0 interest rates, and free money. But with free money comes an increase in asset prices everywhere. In fact, since 2018, the correlation between the S&P 500 and M2 money supply growth was almost exactly 1 for 1. As the money printer went ka-ching, the market went up dollar for dollar. That led to an unprecedented bull market for everyone. You didn't have to know the first thing about investing. As long as you threw darts at tech companies in the public markets, you were making money hand over fist. Share prices for tech companies like Google, Apple, and Amazon tripled in just a couple years. A record number of new, inexperienced investors became millionaires overnight by trading meme stocks like GameStop and buying crypto assets. Venture capitalists in the private markets were raising record funds. Everyone from hedge funds to corporates were trying to cash in on the party, and companies with just $1 million in revenue were being valued at $1 billion. It has been the party to end all parties. But beginning in 2022, the world was forced to wake up from its hangover. And we realized in our drunken haze, we've printed an absurd amount of money. And many of those sexy tech companies were actually lighting money on fire in the pursuit of growth at all costs. Now, valuations for high growth tech stocks have crashed 70% on average. And tech luminaries are saying investor sentiment is the worst it's ever been since the dot-com era. Some 700 tech startups have laid off more than 100,000 people in the last few months. So how much worse can things get from here? To put things into perspective, inflation hit 8%, its highest level in 40 years. The last time inflation was this bad, the Fed raised interest rates to 20%. Think about that for a second. Today, the Fed is considering raising interest rates to 1.5%, and the market's already corrected 25%. So if rising interest rates still have a long ways to go, we may be nowhere near the bottom of the market. It's no wonder that when the Fed's been forced to hike interest rates to combat inflation, it's almost always led to a recession. In fact, every time the price per barrel of oil has gone above 100, we've had a recession. Add to the mix the war in Ukraine, which could drag on for years and could worsen oil shortages and upward pressure on inflation. We could also see massive write-downs of corporate profits from exiting Russia, not to mention uncertainty with China, ongoing supply chain shortages, and the threat of nuclear war. All said, it's possible we could see a further 50% or more decrease in stock markets, combined with government debt crises, massive layoffs, and unemployment. And as bad as things can get in the public markets, the implications for tech startups may be even worse than they appear on the surface. And that's because in private markets, there's no mark-to-market, meaning there's no way for shareholders to freely price and trade stock for tech startups. So these companies naturally avoid raising in down markets so they don't feel the hammer of compressed valuations. Instead, companies raise small inside rounds, cut burn, and push off fundraising into the last possible moment. But the reality is, in a downturn of multiple years, most startups will have to fundraise at some point, and the big hedge funds aren't going to be able to prop them up anymore. And so most companies will have to tap traditional venture capital, and in most cases, inevitably repricing in a down round. So that's how private market valuations typically lag public market valuations by 6 to 12 months. So that's why things are going to get a lot worse before they get better. The tech apocalypse you're seeing now in the public markets has yet to really be felt in the tech startup world. And you have to remember, the past 12 months have seen an explosion of unicorns, startups being valued at $1 billion or more. A lot of these startups barely have a few million in revenue, or in some cases, significantly less. They may have to grow their revenue 50 or 100 times just to raise flat rounds and maintain their billion-dollar valuations. And not only that, but startups have also been pushed by investors to hire like crazy so they can maximize growth and live up to those lofty valuations. That means it'll be even more painful to fire enough people to right-size their businesses. And they won't have the benefit of a steady hand to guide them in many cases, as the record number of new venture funds and investors that flooded into VC have never been through a market correction. So we've got a volatile set of ingredients, with tech companies priced at crazy valuations spending too much money, investors without experience to guide them, and the big money vanishing overnight. It wouldn't be a stretch to imagine half of tech unicorns or more going extinct in the coming years. So what does this all mean if you're a tech employee, investor, or a startup founder? Number one is making sure you have enough runway. Could you survive a few bad quarters as the economy tanks? Where can you trim expenses and headcount without cutting into the bone? Sometimes financial constraints can force companies to right-size in healthy ways and become more creative with their resources. Number two is fundraising. Does it make sense to try to raise sooner or later? What happens if markets dry up for the next quarter? The opening to fundraise this year could be limited to a very narrow window to plan around. And to be safe, companies should try to have more than 2 years runway, and many companies may need to top off with some additional funding now. If it's available, act quickly and don't get too greedy on valuation. Ensuring survival is the most important thing right now. And number three, everyone needs to be prepared for a potential revenue hit. In sales, customers might pull budget for your product. Deals that seemed certain in the past might get delayed or might even never close. On the marketing side, greater economic and fundraising uncertainty may mean that you need to raise the bar on ROI. Having been through the Great Recession of 07 and 08, one important lesson is that no one regrets making fast adjustments to changing circumstance. As Darwin once said, those who survive are not the strongest or the most intelligent, but the most adaptable to change. But there is still hope for the tech world. 2021 saw a record level of new venture funds being raised to invest in startups, including hundreds of new firms and massive scale-ups from mega funds like Tiger and SoftBank, who raised tens of billions. Typically, when VCs raise a fund, they deploy that over the next 2 to 3 years. So all that money that was raised will need somewhere to go. And in fact, in the first quarter of 2022, global venture funding for startups fell, and while that was the largest decline in nearly 10 years, startup funding is still near all-time historic highs. But these funding levels are going to fall off a cliff. The limited partners who fund venture capitalists, like endowments, pensions, and family offices, are completely overexposed to venture right now and not making any new commitments. And so VCs are going to very carefully safeguard the money that they have in the bank. So if VCs who were deploying their funds within a year now stretch that out to 2 to 3 years, as is the historic norm, you could see funding crash by as much as 2/3. And as a result, there's going to be a flight to quality. And that means that the startup world will bifurcate even more into the haves and have-nots. A lot of marginal companies that were getting funded in the past few years might be expecting to raise in this environment, but just at lower prices, and they're going to be rudely awakened when they don't get any offers in the downturn. So the overall number of companies getting funded will drop, but many of the best companies will still be in hot demand and raise large rounds. And those hot companies are going to be the ones that can actually build real businesses that can turn a profit. We're going to see a rotation away from funding companies growing at any cost to high-quality, high-margin software businesses with dependable recurring revenue, sustainable unit economics, and great market leadership. And ultimately, this is what fundable growth and efficiency metrics will likely look like. At least doubling year over year with high margins and strong retention, and close to a 1-to-1 burn to revenue run rate ratio. More speculative companies that could take hundreds of millions to bridge to commercialization, like self-driving car companies, might really suffer over the next few years. And businesses like Thrasio and other Amazon aggregators that relied on cheap capital to buy up other companies might see tough days ahead. It's the very earliest stages of fundraising, though, that may actually carry through the downturn. Fledgling seed stage companies are 10 to 15 years away from going public. So by the time they do, they'll be a decade already into the next economic cycle. So they're just less impacted by the current market environment. They also tend to raise smaller amounts of money that VCs can afford to lose even in downturns. And these new small, nimble organizations can also change direction more quickly in volatile markets, whereas giant late-stage companies can struggle to turn their ships around. You can already see this in the data as the size of early angel rounds has been virtually untouched by the tech bubble. And traditional VC deals have shrunk a lot less than growth rounds from big crossover hedge funds. In fact, those crossover funds is really the segment of the venture market that has crashed alongside the public market. Tiger Global's public hedge fund is down almost 50% for the year, virtually wiping out everything on the venture side. And the same is true of Coatue, D1, and a number of others, which impacts their ability to fund startups. Rumors are that Tiger might even shut down. All of this is playing into a pullback on mega growth rounds where the market has just become frozen. Many of these growth funds are pushing the pause button entirely until the market settles and they can reevaluate. So many of these new tech investor tourists who came from the hedge fund and corporate world and chased venture capital returns will return home to their roots. But the venture capital specialists who've been through downturns before will continue to fund the boldest and most daring founders who are jumping at the chance to start the next Google or Amazon through any market. In fact, the best funds know that the best companies are built during downturns. It scares away the pretenders and leaves the true believers. It cuts out the amount of competition and this unhealthy war for talent that leaves startups paying developers $500,000 per year. The best performing venture fund vintages in this millennia were during the Great Recession. Uber, Airbnb, Square, Stripe, and many of the most iconic startups today were all started as the world was falling apart. Google and eBay built right through the dot-com crash in 2001. And unlike the dot-com bubble, companies today have real revenue and profits. And there's never been a better time for technology. Back in the dot-com days, there were only 100 million people online. Today, that number is 5 billion. And so software markets are so much bigger than ever before. And over the last century, despite world wars, the Great Depression, Black Monday, the dot-com bubble, the post 9/11 crash, the housing bubble, the pandemic crash, if you had bet on technology through all of that, you'd be a huge winner. And one universal truth will always hold. There will be incredible value from unleashing the power of technology on humanity's biggest problems. And looking forward, it's inevitable that we'll see a wave of decentralization from Web3 push power away from gatekeepers. And new startups will have to deflate the unsustainable cost of healthcare and education rising every year, as well as saving our planet and the human race from climate change. If you're a founder ready to tackle these problems, you can check out my channel for tips on how to fundraise. Or if you liked hearing about the tech world, check out this other video on whether Elon can save Twitter. Thanks so much for watching. See you next time.